The U.S. dollar continues to drive the gold market, but our next guest says that might not be the real story. Joining us now is Tony DANAHER. He's the president of Guild Investments. He joins us from Los Angeles. Tony, good to have you on the show.
Thank you for having me.
So here's the snapshot right now as we're speaking. Gold reversing mid-afternoon, up now ahead of tomorrow's big jobs report, trading around $12.51 an ounce, but still sitting below upside resistance around $12.60, which happens to coincide with the 200-day moving average. So, Tony, what do you make of the gold situation right now?
Well, one of the things we've noticed in the past several weeks is there has been this perpetual bid under the price of gold. New entrants, new institutional buyers have been adding it to their portfolios. And it's not clear whether or not that's geopolitically driven with North Korea. You do have the French elections out in front of us. But the main driver, for a lot of your readers is here in the short term, the dollar has been a determinant of the direction of gold. And we expect tomorrow's non-farm payroll numbers could also wreak some havoc on the price of gold. If you get a really strong number and you get a much more, hawkish tone from the Fed that they're going to raise interest rates several times this year, you could take some of the steam out of gold. But longer term, we view gold as just continuing to move higher.
Okay, so you just said you expect gold prices to move higher over time. So does that mean you're anticipating dollar weakness?
Dollar weakness, not necessarily. The dollar can go up and gold can go up. One of the things we've noticed over time is in the periods where gold has acted the best, it's performed the best. You have the 70s, but this is not the 1970s. Inflation is not running away. If you look at the period from 2003 to 2011, what really drove gold was the entrance of hundreds of millions of people into the global economy, starting to accumulate wealth. And what we see happening right now, it began in late 2016 and is continuing into 17, is global economies are doing better. And people in emerging markets and even people in Europe, and they've faced a lot of challenges, their economies are getting better. And for gold to go up long term, we think more important than fear, more important than inflation, is going to be the fact that global wealth is expanding. And as global wealth expands, that drives the demand for gold. And we see 2017 as a year where global wealth, global economic activity will improve, and gold will be taken higher along with a lot of other assets.
Now, we mentioned Friday's jobs report coming out. You just mentioned it could give a big blow here to gold. So you're expecting it to be a robust numbers like the numbers we saw on Wednesday?
It could be a good number, like the ADP number on Wednesday, but you have a lot of algorithms, you have a lot of machine-based trading programs that are set up to behave a certain way tomorrow morning and carry over the next several days. That'll be a function of how strong the dollar gets based on the number, based on what bonds do, and those short-term gyrations need to work themselves out. But when that's done, we do think you're going to continue to see institutional incremental interest in gold.
All right.
Now, gold later this year is a different question because you have other dynamics.
Well, what's your forecast for Q2 here for gold?
Q2, in the middle of Q2, you're going to have the French elections, and the concerns about the euro will have some key interplay into the price of gold and into the value of the dollar. So as the DXY if the DXY spikes up, gold is going to be under pressure. But in Q2, we think that wealth, earnings, stock markets will continue to do well, and gold will just kind of go on in an incremental manner, just picking up buyers along the way.
Tony DANAHER, thanks so much for your thoughts today. Thanks for joining us.
Thank you very much.
And thank you for watching. We'll have the Street's Scott Gamm up next to look at what we can expect with Friday's jobs.